got to tell you, the non-warrantable condo is something that's really interesting, right? Because you're going to purchase a condo and you can't get financing, traditional types of financing for it. What is the solution? But let's first back up and talk about what exactly is a non-warrantable condo.
Sure, absolutely. Great question here. Great topic. So this does come up a lot, I would say, as of late. I mean, last 6 to 8 months, I've seen non-warrantables become commonplace. Essentially, what they do is when they look at a condo association, there are factors. There's actually a questionnaire. We have the association complete. And one of the questions they ask is, about budgeting reserves. They want to make sure that the condo association has enough money to pay all their claims if they come up. Their insurance is in place. So that's the first thing, is enough reserves in place. If it doesn't have adequate reserves, say 6 months worth, wherever it may be, that's one of the red flags. So right there alone, if we have an issue with the budget, that would make a condo non-warrantable, one of the factors right there alone. Secondly, would be something where, let's say there's pending litigation. I've actually had one where there was a woman was bit by a dog in the middle of the condo association. And so there was a lawsuit in place. She didn't live there. And so because of that, being, something that they're being sued potentially, that made the condo non-warrantable as well. That's another factor. A third thing is also about percentage of ownership being, owner-occupied versus investment. Sometimes if you have a heavy, investment, for example, let's say that 90% are owner-occupied, 10% investment. That's good. But if you're in a situation where it's 50% owner-occupied and 50% investors that are renting, then that's an issue sometimes. It also makes it non-warrantable. So there's other factors, but I would say mostly it's owner-occupied they like no litigation pending, and they also like to have the adequate budget in place. Those are the most common to make a condo non-warrantable.
It's not a nail in the coffin if the condo is non-warrantable, right?
Absolutely. I actually have one right now. It's kind of funny we mentioned this topic. I have one in place right now in the Providence area where it is non-warrantable. They went to one lender first, couldn't do it. I actually had a track record of doing 2 in the same development over the last 12 months. So the broker reached out to me, actually from Fall River area, and we actually said, listen, this is what we have to do here. Now, one of the biggest, the slam dunk is, credit score. If you have a good credit score, you're good. I say good credit score. You need at least ideally 660 credit is what we're looking at. I mean, the higher your credit, the better the rate. So 660 is where you need to be. The other part that definitely will help and you really need to have is 20% down. And the reason being is because you can't get PMI on a non-warrantable condo. So that's why they require the 20% down. So, that's the part where it's a little bit of a challenge. You can get funds gifted, though. We get creative. This person used their 401k and took some money from that to help. So, but also putting 20% down, PMI, which means also lower monthly payment. So it's not necessarily a bad thing. It's just a matter of having a larger down payment. Another thing with the financing is the debt to income ratio, they're a little more conservative because, it's something we're going to keep on our books. What that means is a portfolio is that it's our own money. We're lending this out of Northpointe Bank's, actual funds. We're not getting it from FHA or VA or whatever, conventional. So because it's on our books, we have to be a little bit more, open-minded and look at the, the ratios and all the compensating factors. So that's something that, and the rates, we have a 30-year fixed option. We also have an adjustable rate option. But again, I would say as a whole, with non-warrantable being a portfolio loan, it's about a 0.5% higher rate. Nothing crazy, very doable. It's not something where they're going to, price gouge you and you're going to be at 10% or something. It's going to be about a 0.5% higher than market rates.
Now, is there any situation that you have not been able to underwrite in regards to non-warrantable condos? And if so, can you share that?
Yeah, there are situations where, obviously, if the client can't put down 20%, sure, it doesn't work. There's also situations where the debt-to-income ratio, and not to get too technical here, but typically on a conventional loan, it's a 50% debt-to-income ratio, meaning 50% of your income is being used for all your debt, 50% before taxes. Before taxes on your income. So on a non-warrantable, they want to be at like 43%. So you can see a situation where someone was going conventional, was at, say, a 47, 48 debt-to-income ratio, they qualified, all of a sudden we flip them to a non-warrantable portfolio loan, and now that same situation doesn't work. And that's one of the few times. And again, I got creative one time getting a co-signer involved to help with the buying power. But typically, we try to make it work at all costs, gift funds, whatever it may be. I don't want to give up. But every now and again, there's a situation where, unfortunately, there's no other options. Well, then that could be a concern.